So today you're going to discover our formula to diversify your portfolio for maximum returns in any market condition. So grab a pen and paper because you're going to want to write these down. Today we're going to pull back the curtain and show you how to make your investing a whole heck of a lot easier. After all, have you ever wondered what it would be like to wake up in the morning with all the time to do what you want to do rather than what you need to do because your investments are making returns on autopilot? Here's the problem. Too many investors are trapped on the 1031 exchange treadmill, scrambling for another deal, for another property that they will then have to rehab, working harder and harder. And it's not your fault. The tax laws are designed to keep you on that treadmill. And until now, a solution to switch to passive investing without losing your tax advantages was not available. And now that it is, know that it's my intention to help you fix that problem. You'll know everything about passive investing so you can work smarter, not harder. Sounds good, right? So what is passive investing? It is simply a way to take yourself from managing contractors and renters to depositing checks based on my over 20 years of real estate experience. We all know that knowledge is power, and I want that for you. The power to know when to act and have solid options to choose from with your eyes wide open. Does that make sense? Great, because the time to grasp that power is now. The time is now because the markets are changing, and if you're not ahead of the trends, you're left in the dust. So now notice something I'm going to show you. I'm going to show you current case studies and hard data today. And none of that is to be interpreted as any type of income claim, implied or otherwise. As we share actual case studies and our proprietary formulas and forward-looking statements with you today, please honor that what we are sharing contains confidential information and that by watching this presentation, you agree that you hold it confidential and use it with your financial advisors to evaluate proposed investments and for no other purpose. We expect that you will get with all your advisors, your CPA, your attorney, financial advisor, to see how every investment fits into your overall investing plans before moving forward on every investment. This is key because I'll be straight with you. Investments available to accredited investors do involve high risk, and you shouldn't take it lightly. This is not an official offering of an investment opportunity. That comes with each particular fund's documentation. In short, Ironton Capital is not a financial or an investment advisor. We do not promise or guarantee any income or particular result from your use of the information. And your use of this information contained herein is at your own risk. Now, who am I and why should you listen to us, right? If you haven't been following us for a while, here is a mercifully short introduction. Lon Welsh is our founding and managing partner and a powerhouse, quite honestly. After 8 years in strategy consulting with Deloitte and Accenture, he moved into commercial real estate acquisition and development, where he generated over 20% plus IRR over the last 20 years. He's also the founder and CEO of the largest independent Colorado brokerage, Your Castle Real Estate, which contains over 750 agents, over 5,000 annual deals, and $2.8 billion in annual sales. He also founded First Alliance Title before exiting that to Compass. He loves giving back, including serving on the board of directors for Denver Zoo, Boys and Girls Clubs, and the Denver Aurora Ronald McDonald Houses. Moving on is our CEO, Brent Geyer. With over 20 years of experience in real estate acquisition and development land use across multiple states, especially in the urban and resort real estate markets, and with 25 plus years in real estate acquisition and development and over $1 billion in transactions, he's one of our secret weapons. Richard Landry, he is a portfolio management wizard, having managed over $3 billion across equities, real estate debt, and credit products for hedge funds, private equity funds, and public and private companies. Richard joined Ironton to lead the investment procurement and research process. Together, the investment team brings a wealth of experience working in investment real estate. And after all of our ups and downs, do you know what we found? The fastest and most predictable path to financial security and growth is passive investing. If you can put your investments on autopilot, then you're on the way. You're on the way to just where you want to be, which is true freedom, especially if you could do that in a short amount of time. And I believe that's what we all want, freedom to experience life to the fullest while we are still hardy and healthy enough to enjoy it. And ultimately, that is what this training is all about. Just to consider for a moment, how good you'll feel when you can stop trading hours for dollars and actually enjoy your travels, hobbies, and philanthropy. So our ultimate mission today is to help you do that quickly and consistently. And because knowledge is power to do just that, I'm going to dive right in. Is that okay? So when you leave the heavy lifting to the experts, you'll immediately notice how much happier you are and how much easier building a legacy can become. During our time together today, you're going to have the opportunity to see the world of investing through our experienced eyes. And you're going to see how this system has changed our whole take on how we went from active to passive investing and got off the 1031 treadmill ourselves and for our investors. Does that sound good? So jumping in. If you own active rentals right now, even if you use a property management to help, it's a lot of work. So you might have a lot of equity tied up in the properties, and you may be ready to offload the properties and the work. But how do you retain your tax advantage without 1031 exchanges or even a Delaware statutory trust or DST? So there's several well-known options to unlock your equity. Two that I'm going to go through in the near term regarding is a refinance and cashing out equity from the property. And then the next one we'll go over before digging into the rest of it is getting a second line of mortgage on that rental property through a home equity line of credit. So as you'll see here, the current property value in the property is $475,000. I'm being a bit generous on the estimated annual appreciation of 5% a year. I think it's likely will be a bit lower in Denver, maybe around the 2 to 3% mark. So a bit below the historical average based on where the market is today. You can see the current loan balance, the monthly payment, which is P&I only, and then the annual net operating income, which is before debt service. So the current monthly cash flow of this property is $499, or on a 5-year time horizon, it's about $30,000. So if we look at the top part of this table here, the 5-year projection with no changes, the ROI of this property in 5 years is about 16%. Really good. So we're factoring in cash flow, appreciation, depreciation, and principal reduction. On an after-tax basis, we're looking at about 10.7%. So if I can direct your eyes to beneath that, we're going to now cash out this property up to a 75% loan to value. So we're going to pull out our equity, get a new loan at today's interest rates of 7.8%. And we're going to invest $50,000 of our cash out equity into Ironton Capital. So our new monthly cash flow is negative $124. You can invest about $12,500 into our midterm fund to offset that negative cash flow. And if I can direct your eyes to the right here, if you'll see, if we invest that $50,000 in the long-term fund, so our National Diversified Fund, which we predict to be about 17 to 20% a year, and when we blend that return of, let's say, 18%, in addition to keeping the property based on its own return metrics, we're looking at about an 18% blended return pre-tax over a 5-year period. So we're able to get about 300 basis points better in overall return pre-tax. Now, on an after-tax standpoint, that comes to about 14% in the long-term fund. Now, if we look at it in the midterm fund, we're getting about 16% blended return between the property and investing that money, the cash out money into the midterm fund. And on an after-tax basis, we're at about 10.7%. So the graphs below show you a visual representation of how your equity compounds over a 10-year period. And so you can see that the long-term fund comes out ahead over a 5-year time horizon. Let's dive into the HELOC option. So the HELOC option, we're not going to refinance. We're going to keep the property, but we're going to go to a local bank or a credit union or any of our preferred banks. We're going to ask for a line of credit based on the equity in the property. So HELOC interest rates are a bit higher. So you're going to get, typically it's prime plus a percentage. So we filled in 8.5%. That's pretty typical right now, depending on the leverage that you get on your property. So the current monthly cash flow of the property remains the same. You're still getting about 16% ROI in 5 years or 10.7% after tax. But now we're going to take $50,000 from the home equity line of credit, and we're going to maintain that cash flow on the property. So we're still going to get 138 in positive monthly cash flow, but now we're going to take that $50,000 and invest it into either the midterm fund or the long-term fund. And you can see how your wealth accumulates and what the blended return looks like over a 5-year period by keeping the property operating as is, but now getting a line of credit and investing in the midterm fund or the long-term fund. So in the 5-year time frame, we're looking at about a 19% overall return in the long-term fund and a 17% return in the midterm fund. So in both options, this is a clear case where it could make sense to keep the property because the property is still performing very well. 16% ROI in 5 years is pretty good. So still doing pretty well. We don't want to sell. We want to tap into the equity without selling, and we want to reinvest that capital into an Ironton Capital Fund. Now, what we're going to do now is actually show you what it looks like from a sale standpoint. So what happens if we sell the property instead and reallocate those proceeds into Ironton Capital's funds? So what happens if you do sell your home? So many investors initially hesitate about the capital gains tax, but let's look at the actual numbers in a real life case study from a recent investor that we helped. So this investor purchased a rental property for $187,000. And they did a $9,300 renovation. She purchased the property in 2020, and since then it's appreciated in value to $315,000. So I wanted to note one metric here, NOI, that's net operating income. So the net operating income is cash flow before debt service. Now, if you have no debt on the property, then it's just your cash flow. Okay. In this case, there is still debt on the property. So this investor pays about $625 a month on her mortgage. So over a year, it's about $8,400 per year in annual cash flow on the property. So their last renter she didn't leave the property in good condition. So she's looking at she's either looking at doing a renovation or she's looking at just selling it. So let's analyze it step by step. So first, she has about $184,000 of equity. She thinks she'll get about 2.5% in annual appreciation in the future. Appreciation in most markets has been a lot higher than that over the past decade. Denver, historically, it's been about 6% pre-COVID. We believe that it's going to be more in the maybe 2.5 to 3.5% range. So we're going to go with 2.5. So we know her annual cash flow is $8,400 after the mortgage payment. The likely appreciation is the value of the property. So $315,000 multiplied by the expected 2.5% annual rate of appreciation comes to about $7,800 in annual appreciation. So her total return is the appreciation plus the cash flow, which gets us to about $16,000 of equity a year, or about 9% in total return. Now, keep in mind this simple calculation, we're not considering the small amount of principal being paid off on the loan each month. We're also not accounting for the tax value of the depreciation write-off. That can really make the math a little bit more complex, so we're going to keep it simple for the sake of this presentation. So what will happen if she does nothing? So her equity of $184,000 will not have any transaction costs because she's not selling. There's no capital gains tax because, again, she's not selling. So the entire amount grows by 8.9% per year compounded. So that's $16,321 in year one, and then $17,769 in year two. And we can see where she ends up by year 10 by keeping the property. So by the end of year 5, that $184,000 becomes $281,000. And by the end of year 10, that $184,000 becomes $430,000. So not bad. Now, what if she's tired of being an active investor? What if she says, you know what, my time's up. I want to sell the property and I want to do something that's going to produce less headache and give me a potential to earn higher return. So what happens if she sells? So she could sell it now because her tenant's moving out. So it's a good time to get the property ready and get listed on the market. So we multiply the value of the unit. So $315,000, we're going to multiply that by the transaction cost of 6%, gives us an estimated $18,900 of fees. So that would include, the fees would include real estate commissions, title fees, local transaction fees, Every market could be a bit different. So if you have a better number that you can go off, maybe if you're in another state, et cetera, feel free to plug in that number, whether it's 4 or 5%. If you're a real estate agent, I usually lower this to about 3.5%, because you might sell the property yourself and collect the commission. So that's one other way around it. So one thing I'm not factoring in here as well, keep in mind, is depreciation recapture. So if they sell it, there's going to be a depreciation recapture. So we're just sticking to the net sales proceeds after transaction costs. And again, if you're going down this road, please always confirm numbers with your CPA. So let's imagine she sells it. Let's imagine that she doesn't want to reinvest the funds into another property. She just wants to take a passive approach, but put it into the stock and bond market. So historically, that's returned about 8.1%. Her $184,000 of equity today would be $135,000 after the tax payment and the sales costs. So that $135,000 grows to $295,000 over a decade. So she'd be making more. She'd make more keeping the property and dealing with the headaches, but the stocks and bonds are an easy and very liquid path to wealth, and she can access these funds at any time she wants. So that's unfortunately not true with real estate, which again is usually not liquid. So another option is to sell and invest in our medium-term income fund, which pays between 11 and 13%. So we split the middle and we put it at 12% here. So you can see that after paying the taxes and transaction costs, the nest egg grows to $420,000 over a decade, assuming that the dividends are being reinvested each year. So that's only $10,000 short of the wealth creation if she kept the investment. So this is passive, and it generates reliable quarterly cash that she can use for living expenses. Now, the final option would be to sell and invest for the long term in the National Diversified Fund. So we target about 16 to 20% annualized returns net of expenses. And a nice feature is that we have 2 share classes for NDF. So we have one share class, which has a slightly higher preferred return and does not generate any depreciation for the investors in that share class. So this tends to be a great choice if you're investing in your individual retirement account, or maybe you're investing with cash and you can't use the passive losses to help your tax situation. So please check with your CPA just to see what might be best for your situation. The other share class, our share class B, has a slightly lower preferred return, but we're giving you all the depreciation. So if you get the depreciation shares, it can usually be used to offset some or all of your capital gains from the sale of your investment property. So in this case, we're able to cut the tax bill by a considerable amount. And the remaining equity, so we're starting with $184,000 in equity. We're deducting the transaction costs and we're taking away the capital gains tax. So the original capital gains tax was about $25,000 to $30,000. So we were able to cut that down significantly. So her leftover amount to invest is about $150,000, put into the fund at 17% compounded over a 5 to 10 year period. That original amount to invest of $150,000 grows to $328,000 by the end of year 5. So compared to the do nothing scenario, we're about $40,000 ahead. And then compared to the do nothing scenario by the end of year 10, we're almost $300,000 ahead. So your investment, hypothetically, if we hit 17% a year over a 5 to 10 year period, grows to $328,000 by the end of year 5 and $720,000 by the end of year 10. So what's the bottom line of these scenarios? Do nothing and sell in 10 years and make have $430,000 in equity. Sell now and invest in the income fund, which produces quarterly dividend income. And if you reinvest, your equity grows to about $420,000. Or sell now and invest in the National Diversified Real Estate Fund, and your equity would grow to about $720,000. So for her and this investor, the choice came down to how much liquidity she needed in her portfolio. And really, this is why we founded Ironton Capital, to make these types of options available to individual investors, especially active ones, who are not big enough to have a family office finding the deals for them, but who deserve to finally get passive after years of active investing grind. So as an active investor, we are what we call a project sponsor, and we are responsible to do all of the following. So select the physical project. The project sponsor arranges and guarantees the financing, arranges the permitting, and goes through that process, oversees construction or renovation. They manage the property inside and out. So they find the tenants, they manage the tenants, they maintain and manage the property, and manage any legalities throughout the process. They go through the refinancing, if there is one, and they manage the sale of the property. What I wanted was to be in the position of a limited partner, where all I had to do was choose the fund, decide the investment size, read the quarterly reports, if I choose to, reinvest and deposit the returns, and enjoy passive financial freedom. And that link got me from all the work to all the reward, which is what we do at Ironton. We are the general partner. So we find the projects, we do the due diligence and oversight so our LPs can sit back, read the quarterly reports, and enjoy diversified real estate investments in their portfolio without all the headaches of active investing. Because when it comes down to it, these two lists are the difference between active and passive investing. And really, it's just a question of how much time and resources you have to dedicate to real estate versus the rest of your life. So the expected internal rate of return for NDF10 is about 16 to 20% per year. So hypothetically, if you put $100,000 in, we would hope that in about 5 years into it, you'd get your $100,000 back and about $90,000 of profit. The term is about 4 to 6 years. You'll get hopefully most of your money back by the end of year 4, with some of it coming back starting in year 3, and the profits coming back in years 5 and 6. So there's always a possibility that one of the multiple investments that we make might take a little longer than that. And then we also do have some tax advantages for accelerated depreciation. So if you're currently an active investor and you're selling a rental property, you're going to have some capital gains, and you're going to have to report that to the IRS. The advantage of being in the depreciation share class is that you may be able to, again, check your CPA, use that depreciation to offset the gains in that same year of the sale of your rental property. So more on that in a moment. Plus, every NDF diversifies in 4 important ways to manage risk. Pillar 1, geography. So we want multiple investments in key markets. Our investments cover most of the best real estate markets in the country, giving us geographic diversity and therefore limiting your geographic risk. So in this case, more than 10 states. Pillar 2, asset class. From residential to apartments to industrial and self-storage and more, we want multiple asset classes. So in NDF10, we cover multifamily, industrial, residential, and hospitality. Pillar 3, strategy. So we want multiple types of investments that are trending advantageous in the current and coming market conditions. So in NDF10, these are value add, where we buy an existing asset that's been neglected, we renovate it, bring the rents back up to market. And I really love this strategy because you really have a lot of control over your destiny. The other strategy that we like a lot is development of new build projects, etc. Pillar 4, sponsor. We like to work with proven sponsors who've got a long track record of solving problems in this asset class and in their geography and strategy that they like to work with. So they deeply know their geography and all the city planning and zoning. They have the connections. They know how to get things done. So in a minute, I'm going to share some of our proven sponsors across our fund. So here's what that looks like in practice. So our investments cover most of the best real estate markets in the country, giving us geographic diversity and therefore limiting your geographic risks. So this is something that would be very difficult for an individual to replicate to get this kind of geographic spread. You'd have to call hundreds, thousands of people. You'd have to have millions and millions of dollars to allocate to get this level of geographic diversity and in the projects that we're able to invest in. So here's a list of some of our historical returns we've seen. So NDF1 is closest to closing out, and we're tracking to about a 14 to 16% IRR. One you're not seeing here is the Verico warehouse, which we just sold. That returned a 17% IRR to our investors. And you can see how the rest of the investments are tracking. And beneath that, we have the income funds, which continue to perform right within our target range. So many of our investors like to keep 3 months of income in the bank and the rest in the short-term income fund, where they can get the money out with a 30 days notice. So if you're starting with $100,000 over a decade, you could generate an additional $62,000 after tax in the short-term income fund. This fund returns about an 8 to 9% net of fees, pays quarterly dividends, is diversified across a real estate hard money loan fund and medical receivables. And what's great about this fund is it's taxed at a lower REIT rate. So it has REIT designation status, which means it's taxed at the 20% federal level. Again, please talk with your CPA to explore and confirm the tax benefits. Next up, we have the medium-term income fund, which has become a very popular fund for a lot of our investors looking to diversify out of the stock market or diversify out of real estate and have no correlation to a lot of the economic volatility that we're seeing today. So this fund returns 11 to 13% a year and also pays quarterly dividends. Your return, your unique return, is based on your assets under management across all of Ironton Capital. So you can get some liquidity, but we do ask for a 3-month notice. We just ask for a 1-year lockup of your money, and then you can request a portion or all of your capital back. This fund is diversified across a medical receivable portfolio of over $25,000 individual invoices. And so as you can see, that's why our investors like leaving the heavy lifting to us. Like Jared, who after 15 months struggling nonstop with his rentals, he sold many of his rentals to invest passively with Ironton Capital. He says, it feels good to have time back with the passive investments that I have. Ironton made it really easy. Really appreciate you, Jared. Maybe you were like Jay, who shared Ironton Capital helped me reduce the time and headaches I had when I managed my rental. Jay actually sold his rentals, and not only has it made his life easier, but we're on track to beat the returns of his rental properties as well. And like Heidi and her husband, who like the access that Ironton Capital provides to geographically and diverse real estate portfolio that is carefully curated with established development partners. So now imagine and picture this. You finally get your time back, time to relax and enjoy quality time with the people who matter while your portfolio continues to grow. I want that for you. So let me ask you, did we provide value for you today? Did you get some insight into what you might be missing when thought passive investing in real estate was out of your reach? Would you like more? Because every investor is not the same, from long-term growth to short and medium-term liquidity. At Ironton Capital, we have funds to fit many portfolio strategies, mostly real estate, but some that are completely uncorrelated from the real estate or the stock market, such as the medium-term income fund. So before I give you this opportunity, let me share with you the features and benefits. So joining Ironton Capital will give you rapid results because we do all the finding, touring, and due diligence for you. And since we have more time to do that, you have more time to do what you want, when you want, with the people that matter, enjoying greater diversification across geography, asset class, strategy. And this investment is entirely and truly passive, because we do all the heavy lifting, providing quarterly reports and updates, and you depositing the checks. Is that making sense? So if I did a good job, would it be okay if I share with you how you can go deeper with us if this is right for you? So now, this investment is not for those who want to keep doing it the hard way. This is for accredited investors who are done dealing with renters or looking at endless deals and are looking to leave the heavy lifting to the experts. So what is an accredited investor? So regulations, SEC regulations, specify that you must meet only one of these 3 criteria: single household income over $200,000 or more in 2 or more recent years, dual household income over $300,000 or more in 2 or more recent years, or you can have investable assets excluding your primary residence of over $1 million. If you meet just one of those 3 criteria, then you are an accredited investor and you can invest with us. So keep in mind that there are many ways to fund your investments. Many of our investors have used the following: cash, self-directed IRA. As I presented in the previous opportunities, they've taken a cash out with a line of credit, or they've refinanced their property that's had a lot of debt equity trapped in the property. Already mentioned HELOC and already mentioned the second mortgage line of credit. So we are truly invested in making this world a better place with you. So our general partners have donated over $250,000 to these charities in the past 5 years. And we're excited to give more as we succeed together. So our plan is to donate at least 10% of our profits either to local charities or nonprofits chosen by our limited investors. Now, because investing is individual to each person, we set aside some time for you and we'd love to hop on the phone with you and answer all of your questions. You can use this direct link to book a 15-minute call with our investor relations team. And you can share your investing goals and see if Ironton Capital is a great fit for your goals. It's not just about returns, but the time you've also invested in making them. We're here to make this process a lot easier for you, but our time is limited. So please go ahead, book now, and we'll talk soon.